If you've been following Canadian real estate in social media and the news, you would be familiar by now that there's this anticipated mortgage renewal cliff, that somehow all of these homeowners that are going to be renewing all at the same time at rates much higher than they can likely afford is somehow going to bring the Canadian real estate to a crashing halt. That all of these homeowners are going to have to list their houses for sale because they won't be able to afford them. But is that actually going to be the outcome? To have a conversation on this, I called a friend of mine, David, who has a 35-year career in mortgages and real estate and currently works at Manulife Bank, to get his perspective. And he seems to think most Canadians are going to be just fine.
These are blanket statements that don't apply to everybody, but by and large, Canadians figure out a way to make their mortgage payments as long as there's income coming into the household. Our delinquency rate continues to be very, very low. And we've already had a big chunk of people come up for renewal at these higher rates, and they're figuring it out. Plus, there's lots of options available to a lot of these folks.
And I have to agree with David on that point. Most Canadians, at least historically speaking, are very resilient when it comes to their housing. We seem to have a fetish for housing, or at the very least, we want to try to avoid sleeping on the streets when it's minus 40 outside. As Canadians, we're willing to let a lot of things go delinquent, like our car loans, our student loans, our visas, our lines of credit, before we'll even consider allowing our mortgage payments to go delinquent. It also doesn't mean that Canadian real estate is going to go through 2024 completely unscathed. Higher mortgage rates aren't the only factor that impacts whether someone can make their mortgage payment or not.
I think one of the largest factors that always plays into people being able to make their mortgage payments is first and foremost employment. As long as we continue to have strong employment numbers, Canadians are pretty good at figuring out a way to make their mortgage payments. When people tend to get into trouble and when concerns really start to arise is when we see unemployment numbers climbing.
At least for now, unemployment isn't a big factor with whether or not people can afford these much higher mortgage payments, although that could change in 2024 depending on what kind of recessionary pressures we feel. But recessionary pressures or not everyone is going to experience 2024 in the same way. About 2/3 of Canadians own a home, with about half of those owning a home with no mortgage at all, and the other half owning their home with a mortgage balance, but a wide range of mortgage balances.
There's an awful lot of Canadians that have relatively low mortgage balances, and that's something that doesn't get covered. Not everybody is feeling the pinch.
And it's true, not everyone is suffering under these higher rates. But what if you're one of those people where your mortgage rate is doubling at renewal, or one of those people who has negative amortizations because you had a variable rate mortgage that got out of control? Or what if you're one of those people where the house price has now dropped since the time that you bought it and you're now underwater, where the home price is now lower than the mortgage that you owe on it? Then certainly you're in trouble, right? Well, even then, not necessarily. What matters more than all of that is which mortgage lending category do you fall in?
It gets very confusing for consumers because there's uninsured, there's insurable, and there's insured. And they're all three different animals completely.
So let's first talk about the solutions for the mortgage holders that can be helped, and then let's talk about those mortgage holders in that special lending category that are going to face some serious challenges. When you first bought your home, if you put less than 20% down, you would have had to pay mortgage default insurance fees. You would have known this either as CMHC fees or Sagen fees or Canada Guaranteed fees. Meaning from a lender's perspective, your mortgage is insured. If you put more than a 20% down payment though, but you were still buying a primary residence or a second home or a cabin, and in most parts of the country you were buying a home under $1 million, then you were likely insurable. Meaning that while you didn't pay the mortgage default insurance premium directly, you didn't pay for the portfolio insurance, the lender likely grouped your mortgage along with several others and bulk insured them with the insurer. Which means that if you bought a home like an expensive home or a rental property that couldn't fit the insured or insurable category, your mortgage was uninsured. But here's the thing, those that could and did pay for the mortgage default insurance premium are about to discover at renewal time in 2024 that they're going to have a few superpowers that are going to help alleviate some of the challenges that they thought they were going to face.
Yeah, that is the case. And the other thing as well with an insured mortgage, if it was default insured, the current property value doesn't matter. And so if they've had a drop in property value, it doesn't matter because the mortgage is insured and it was insured at the original purchase price. And therefore the new lender can just move it over without having to stress test it using the current contract rate and not have to reappraise the property.
So yeah, they don't have to worry about what the value of the property is. The lender isn't going to care because it's insured. And they also don't have to qualify at the stress test. They can qualify at whatever rate they're going to get. And it doesn't stop there. Leading up to 2024, there were countless videos and countless articles talking about all these static variable rate holders that were going to suffer from these negative amortizations. Because while interest rates had climbed, their payments had not, and now it was time to pay the piper. But once again, for all of those mortgages that were in that category but were also insured, they had a couple options. The first and most obvious option available to them is if they had extra savings and investments at their disposal, they could simply make a lump sum payment against their mortgage and bring their balance down to where it's supposed to be, make the mortgage current. Or if they had extra equity in their property, they could simply refinance and make the lump sum that way. But if your mortgage was insured, you didn't have to make that lump sum payment back all at once at all. Instead, what you could choose to do is take the amount that you were left outstanding and just add it back into your balance. Now, what this means is that by doing that, you're going to end up with a mortgage payment that's slightly higher than it otherwise would have been without that balance built in. And yet, it's likely much lower than the payment that you likely qualified at using the stress test when you originally got the home. So all of these insured mortgages that were seen as a problem, that didn't have enough equity in the property, or maybe wouldn't qualify at the current stress test, or maybe even had negative amortization, all of them aren't going to be as much of a problem as people originally thought they were. Now, for those that didn't pay for the mortgage default insurance but still have a lot of equity in their property, there's a lot of options that exist for them as well, including the ability to refinance their mortgage and make those payments more affordable by stretching out the amortization again. On top of that, if you have enough equity in your home, you can also use this as an opportunity to build in some of the debts that you might have acquired over time and put those and consolidate those back into your mortgage, like student loans, lines of credit, and maybe even car loans. By doing that, yeah, your mortgage balance will be larger, and by extension, you're going to have a larger mortgage payment. But because you've removed all these other payments that are associated to these other debts, your monthly cash outflow is going to be lower. No, the people who are most at risk in 2024 are those that paid more than 20% down and skipped out on the default insurance, but also at this point in time, maybe because of reduced property values, don't have a ton of equity in their property. They are lacking meaningful options. Now, if you're investment minded, you might be thinking to yourself, oh goody, those are the people I should be going after if I'm looking for a great deal on real estate. After all, it's only a matter of time before they default. But the truth is, with the health of the current economy and with unemployment still relatively low, you may be waiting a while.
We're not there yet currently. Like I said, the employment numbers continue to be strong and lack of housing inventory. So there's still a lot of room for things to absorb any defaults that do occur.
The other groups that could be impacted by this in 2024, but probably to a lesser degree, are those insured and insurable mortgages where maybe they don't have a whole lot of equity in the property, but they've also amassed a significant amount of unsecured debt that would prevent them from qualifying at other lenders. In that case, their current mortgage lender is probably going to offer them a renewal. They'll just lack the ability to qualify elsewhere to try to compete for a better offer. Other types of mortgage holders that might struggle at renewal are those people with harder to validate, harder to verify incomes, like in the case of self-employed individuals. And that's especially true if the tide of the economy starts to shift. I think what's more important for us everyday Canadians is to worry less about whether the average Canadian is going to be able to make their mortgage payment or not, and focus more on shifting our mindset to one that's more empathetic.
Like I think it's time we need to stop thinking of housing as a commodity. We need to start thinking as houses as homes. People need to live.
Thank you for the 20-cent tip, Fardeeds. Appreciate that. That'll go to a good cause.